Hello and welcome everyone. My name Mr. J.M. Kimani. Welcome to lesson 9 of costing methods. Lesson 9 focuses on byproducts. Remember, in lesson 7 and 8, we've looked at the joint products. Now we are going to look at the byproducts in this lesson. Now, byproducts are products which are recovered incidentally from materials used to manufacture the main products. They are one or more products produced incidentally during manufacturing of the main products. The distinguishing feature of a byproduct is relatively of low sales. The distinguishing feature of a byproduct is relatively low sales value when compared to the main product. Joint costs will only be allocated to the recognized main products. That is, no costs are allocated to the byproducts. Now we are saying that the distinguishing feature of a byproduct is that it has a lower sale value, in fact, indeed, low sale value compared to a main product. Another issue is that it is an incidental product. It was not purposed, but as we do our main production, aiming to get main products, incidentally we end up getting a byproduct. That is how it is arrived at. Now, examples of byproducts, for example, we have sawdust and offcuts in timber processing. We have molasses in sugar processing, and other examples. Now, what we're looking at is, as we're having a main product, we end up having a byproduct which has a lower value compared to the main product. For example, like the value of sawdust, the value of offcuts compared to the value of timber as the main product. So that is the distinguishing feature. At the same time, you may not be able to avoid this byproduct. For example, like the sawdust, you can avoid it if you were to determine, or you were to get maybe timber, or offcuts if you are to get timber from logs. So that is, those are examples of byproducts. Now, accounting for byproducts. Accounting for byproducts. Now, any amount realized from byproducts may be accounted for as follows. 1. Sale value or NRV of the byproduct is added to the sales of main product. That is, treated as additional revenue. Roman 2. Sale value or NRV of byproduct is deducted from cost of production of the main product. That is, main product is valued at net cost of production. And Roman 3, amount realized from byproduct is treated as miscellaneous income and transferred to the income statement as other incomes. Now, these three treatments are very important, that either we treat it as just like any other income, or we treat it as a deduction of the cost of the main product, or either as a miscellaneous income in the income statement. That is, those are the three. Now, an illustration for us to understand those three. Illustration reads that the following data was recorded by ABC Limited. Cost of production, shillings 1.2 million. Sale value of the main product, shillings 1.5 million. A byproduct produced and sold at shillings 10,000 net realizable value, then calculate the profit using the three methods above. Now, we have the byproduct, we have the cost and the income or the sale, and we have, we have the main product, which is the cost, and also the income, and we have the byproduct, which you are given the NRV. Remember, NRV means we have taken the sale value of it, we have deducted any processing cost of that byproduct for it to become sellable. Now, we are going to have these two methods as follows. The first one is when you are using this one as a revenue. So treatment as revenue. So if that's the case, we'll have the sales of the main product. We have sales. We have main product is actually 1,500,000. Then you have sales of the byproduct, which is it is 10,000. So sales of the byproduct, that is it. Then now we can say less the production cost. Production cost, which is 1,200,000. So that means our net profits, so our net income is actually 310,000. That is the first treatment of byproducts. The second treatment is that we are having here Roman 2, we have treatment as treatment as a deduction. This is deduction of production cost. So treatment as deduction of production cost. So you can have here sales. This is main product of 1,500,000. Then we less the cost of production, which is 1,200,000. But before we subtract this from the income of the main product, we reduce this cost by the NRV of the byproduct. So we have here byproduct NRV. Now, NRV is the income from the main product, from the byproduct, and because the cost of the byproduct is now borne by the good production, so does the revenue of it will have to be attributed to the main product. Therefore, we offset this is an income, this is a cost, we offset, so this becomes 1190,000, and therefore when you're subtracting it, you'll get actually 310,000. That is the net income. So we still have the same result, but the treatment is different, as you can see. Then the last one Roman 3, is treatment as this is other incomes, as other incomes. So this one will be in the income statement or either the P&L. So we have sales. This is main of 1,500,000. Then we less cost of production, which is 1,200,000. So that you can have the income or the profit. Let's have here the profit of the main product. This is the 300,000. Then we add other incomes, which now is the byproduct NRV. We are having an income of byproduct NRV, which is 10,000. So therefore we have 310,000 as the net income. So you have net income of 310. Now, you'll note that all of them, they have the same result, but where we place this byproduct is the concern. Here we place it as a main product, and we're having the two revenues as if they are the same. We are having treatment as a deduction, where we have the cost of production, and we subtract the NRV of the byproduct so that we can have the net cost. And then here we are treating it as other incomes in the income statement. And therefore, it's after we have done the main product, we have other incomes, and we treat that there. Now, you'll note that the recommended method is this second one. This is a recommended method where we treat it just like the way we treat a normal loss. If you can recall, normal loss, we normally say that the cost is borne by good production, and therefore the scrap value of it is taken to deduct or to reduce the cost of production. The same story here, we are going to treat it that way. This is the recommended method. As we do any other question, we are going to use this second method. Now, an illustration so that we can be able to see the treatment. Illustration reads that a company uses a process costing system in its operations. In one of the production processes, two joint products, A and B, and a byproduct, C, are produced. The following additional information is provided. 1. Each process require 12,500 kilograms of input. The costs incurred are materials 456,250 shillings, labor 295,000, overheads 268,750. Number 2, it is expected that 20% of the input will be damaged in the production process. This is sold as scrap at shillings 10 per kilogram. The damaged units are detected at the end of the production process. Number 3, the output from the production process is as follows. Product A, B, C, output 50%, 40%, and 10% respectively. Then you have selling price per kilogram is 200, 250, and 20 shillings respectively. Then number 4, product A has to be processed further at a cost of shillings 100 per kilogram before sale. Number 5, the joint costs are allocated to the product on the basis of net realizable value. Required, Roman 1, determine the total cost of the output from the production process. Roman 2, calculate the allocated joint cost for product A and product B. And Roman 3, prepare a process account for the production process above. End of question. Now, we do have the number of units that have been put in the process, 12,500, and we have been given the costs that we are incurring this process. But the output of this is what you're being told. There is a normal loss of 20%. There is the output of product A, B, C, knowing that product C is actually a byproduct. And looking at the percentages given to the product A, B, C, they are actually giving us 100%. That means this is 100% of the output after the normal loss. Or either it is 100% of the input after you have deducted the normal loss. Otherwise, if normal loss was not had not been subtracted, then normal loss being 20%, the output of product A, B, C would have been 80%. But as long as it's giving us 100%, that means you first of all deduct the normal loss, then what you get as the good production, you now share product A, B, C. And because there is no actual loss reported, then we take the expected loss as normal loss is the actual loss. So there is no abnormal gain, no abnormal loss. Now, the first thing to do, as we are asked in Roman 1, determine the total cost of the output from the production process. We require to add, to use this treatment. We take the total cost of production and we subtract the NRV of the joint, of the byproduct, so that now we can have that cost, so that we can come and allocate it in Roman 2. So we'll be having this kind of solution. So we have in Roman 1, we have, this is process cost. This is process cost. This process cost, of course, it is materials. You add labor, you add overheads. So meaning we do have 462. No. We have 456. Or else, let me indicate here, materials. We have labor. We have overheads. This is 456 to 50. This is 295,000. This is 268,750. That is a total cost that will be incurred in this process. But again, because of the normal loss, because of the byproduct, so we require to actually adjust this by